One of the intriguing stories of the week was a piece of work from Societe Generale's Tokyo-based rate analyst, Christian Carrillo. Basically, he set out to skewer the view that the big four Australian banks raised their mortgage rates because their funding costs were rising. His note said the mortgage hikes seem aimed at protecting their high profit margins. God forbid. Here's the man himself, and then Reserve Bank Governor Glenn Stevens, who also waded into the debate at a parliamentary committee hearing on Friday.
It became pretty apparent that, as a whole, the industry could not really be suffering under the strain of sharply rising funding costs, and therefore it was unlikely that the RBA would have to cut rates in the same way as it had done in 2008.
I think when people say that those costs have risen, that is true. I'm not here to defend the banks. They can defend themselves, but most businesses seek to reflect their costs in the prices of their products, if they can, and that industry is no different in that respect.
That's funny. He was exactly there to defend the banks, I think.
It's a bit oxymoronic, isn't it, to have a French banker talking about profitability if you want to take a cheap shot.
Well, exactly. But I've got a couple of the things that Christian Carrillo was talking about. He said average term deposits are down 30 basis points, special rate deposits down 80 basis points, online savings accounts down 50 basis points, cash management accounts down 60 basis points. So he went through them all. They're all down. So what's wrong with that analysis?
All that's true, but that's only one dimension of a two-dimensional situation. I mean, banks have assets and they have liabilities. They have to pay for their funding and they charge against their loans. So it's the relationship between the two that counts. There's no doubt that interest rates in Australia and overseas have come down as central bankers have pushed them down. So the yield curves now have a much lower shape to them. But that's not the point. The point is the difference between what they borrow and what they live at.
He's also ignoring the fact that the rate cuts last year were actually passed through. So he's referring to falls in deposit rates of late last year, but the rate cuts were passed through. So, you know, and frankly, bank profit margins have been flat. So, yes, he's right. They've protected their margin, but it's not as though they have withheld at this point.
In fact, they've lost a little bit of margin. I think in the last quarter it's down about 10 basis points.
There were small movements in the margin.
Margins on massive volume. I mean, at the end of the day, they struggled along and made 32 billion pre-tax last year. We're the only country in the world where 4 of the 5 most valuable companies are banks. They're worth 250 billion. They're struggling along. I think that, we have the world's most expensive banking system, and frankly, any way you cut the economics, as far as I'm concerned, we have too much market power in an oligopoly, and I'm just surprised the regulatory backlash and the consumer backlash hasn't been a whole lot stronger against rises in mortgage rates, when they're still making an absolute fortune.
But it's better than insolvent banks.
Well, but I agree. But do you need to be worth 250 billion? I mean, why have Australia got 4 of the 20 most valuable banks in the world?
Well, maybe because they didn't make the mistakes that many of the other banks did. But yes, we have a relatively concentrated industry sector. You can debate endlessly whether that's good or bad. It certainly helped us during the downturn. You can't make statements about nominal billion-dollar levels without referring, as Steve said, to the asset base. What is the asset base into which you're making that from? Referring to our banks being large organisations, that's frankly just a factor that we don't have a lot of other industry structures in Australia, certainly in the equity market, we don't. So
I just don't remember the time that the shareholders wrote out cheques for $250 billion to put that equity in. I mean, the dividends and the capital returns over the years have far exceeded, many times over, the total capital ever actually written into the banks. We can talk about this all day.